This workshop is brought to you by the UO Financial Wellness Center, and this is Investing 101, an introduction to the basics of investing. Hopefully you're all in the right place. And as for a little introduction to myself, my name is Lucas Murphy. I'm a peer financial coach with the Financial Wellness Center. My background is in accounting. I'm currently in the Masters of Accounting program here at the UO. And should you have any questions, please feel free to shoot me an email. I have it listed right here. And with that, let's get started. So before we get into the bulk of our workshop, I have a few slides on the Financial Wellness Center and the services that we provide to students. So here at the Financial Wellness Center, our mission is to financially empower students with the knowledge needed to make sound financial decisions during and after college. And our focus areas, or the big five as we call them, are earning, spending, borrowing, protecting, and saving and investing. And being that this is a basics of investing workshop, we will be focusing on the saving and investing pillar of the big five, but we have resources covering the other four available on our website at financialwellness.uoregon.edu. And as far as how we reach UO students, we provide financial education workshops like this one to students. And the nice thing is that if you're unable to make the live session, all of our workshops are recorded and added to our website for on-demand access. And once again, you can check us out at financialwellness.uoregon.edu to see our past and upcoming workshops. We also offer one-on-one peer financial coaching appointments to give students the opportunity to ask for information or clarify on whatever specific financial topics they might be curious about. And given the current circumstances, these are, of course, conducted over Zoom for the time being, but we do hope to get them in person probably next year. And finally, the Financial Wellness Center strives to build partnerships across campus, whether that be with student athletes or graduate programs or on-campus clubs. We are hoping to offer financial wellness enrichment opportunities to all UO students. All right, so the agenda for this afternoon, we'll start with the basic definition of investing, along with some explanation as to why one should consider investing. We'll then touch on some of the most common types of investments and their associated risks and returns, followed by a few helpful investing resources that new investors can use to their advantage. We will then discuss the process of picking a broker, and finally, a few closing comments and a Q&A at the end. But if you guys do happen to have any questions during the presentation, you can just go ahead and throw them in the chat and I'll try to get to them. So for the learning outcomes for this workshop, hopefully you will be able to leave with an understanding on what exactly investing is, the long-term nature of investing for your future, an understanding of the different types of investments and their risks and rewards associated with them, as well as how to pick a broker and understanding the fees that are associated with them, if any. All right, so what exactly is investing? A basic definition is the act of allocating resources, usually money, with the expectation of generating an income or profit. The key word here being expectation, because investing involves taking on risks, and investing is different than just saving your money. So this picture on the right is a hypothetical illustration of investing versus saving. And as you can see, with saving, this bottom line here, there is little to no risk, but the returns, so on the x-axis is time, y-axis is money or return. So little to no risk with savings, a very smooth line, but the returns are pretty minimal. And as for the investing line, the up and downward movements indicate the risks that are associated with investing, as well as the much greater return in comparison to saving. But however, these returns are not guaranteed. So there's much more risk associated with an investing than saving. And investors use the word volatility to describe the frequency and extent to which the price of an investment moves up or down. So here's a little graphical illustration. So the blue line indicates kind of like that savings line on the left, the last chart. It indicates very low or no volatility. See, it's a very smooth line. And the green line indicates a much higher volatility with these up and down movements with the value of the asset. And another aspect of the riskiness of investing is that it is very difficult to predict what will happen in the future. It's hard to predict whether a company will perform well in the future or perform poorly, It's hard to predict if there will be a stock market crash or a boom in the stock market. It's hard to predict if a government or a company will be unable to repay their debts in the case if we're talking about bonds. And in comparison to saving, there are both gains and losses that result from investing. And the trick is to be well enough diversified so that over time, your gains will outweigh your losses. Okay, and so one way to adapt to the inherent volatility of the prices that comes with investing is called dollar cost averaging. Dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. So these purchases occur regardless of the asset's price and at regular time intervals. Say, for example, if you want to invest $100 into some stock, rather than investing all of the $100 at once, you might want to invest $20 a week for the next 5 weeks. And by doing so, you are reducing the overall impact of volatility on your investment because the price of whatever you're investing in will likely vary each time over each time period that you're purchasing. As a result, the investment will not be as highly subject to volatility. So using dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed with regard to the asset price. So that kind of goes back to that first question we had at the beginning about timing the market. So instead of pumping in your entire $100 into the stock when it might be at a high point and then watching it fall over the next few days, you can average out the costs of the investment over the different time periods to reduce your exposure to volatility. All right, so now that we've touched on what exactly investing is, the risks that come with it, and how to mitigate some of that risk with dollar cost averaging, we'll now get into the reasons why one should consider investing. So with investing, you might outpace inflation, which is a fall in the purchasing power of money. And if the rate of return on an investment is greater than the inflation rate, then you are outpacing inflation, or your investment is growing at a faster rate than the rate at which the value of the dollar is declining. Additionally, if you hold on long enough, you will reap the benefits of compounding interest. For example, let's say you invest $100 into some asset that has an average yearly return of 10%. After 1 year, its value will be $110 with that 10% return. But after 2 years and another 10% return, its value will be $121. So in the second year, it grew $11 instead of $10 in the first year. And although it might not seem like that's a big deal in the short term, a $1 difference in this very basic example, this exponential growth that results from compounding interest can result in huge returns if given several years of compounding along with consistent investment. And we'll see a bit more of that here in a couple slides. Additionally, saving alone might not be enough for your future goals. The bigger your return on your investment, the less you have to set aside for the future. All right, so for more on why one should invest, here's a chart showing the historical average returns for different types of investment. And keep in mind that these are averages. At one point in time, it could be higher, it could be lower, but this is the average return. And as you can see here, stocks, which are on the left, provide the highest average historical return of about 10%. And this is measured by the S&P 500 index, which we learned earlier is a metric that tracks the performance of the largest 500 US corporations. And followed by that are bonds at about a 6% return, which is measured by Barclays US Aggregate Bond Index, which is a big bank that creates another index similar to the S&P 500 index, but this one tracks the performance of bonds. And finally, traditional cash investments earn the lowest return. This chart says about 3%, but I think that's a bit high. This is using a 30-day treasury bill as a proxy. Perhaps a more applicable approximate would be a traditional savings account, which on average, they earn less than 1% interest annually. And in comparison, while right now the inflation rate is a bit lower than this 2.7, it is currently at about 2.2%. The rate of inflation is still higher than the average return in a savings account, which is less than 1%. So these are some things to keep in mind as we move forward in the presentation. And if anyone is curious, these numbers are provided by the USAA Educational Foundation. So here's a better illustration of that idea of compounding interest I had mentioned earlier. Again, this graph is also hypothetical, but it does a good job of illustrating the historical average returns of different types of investments. So we'll look, so if you were to invest $250 per month over the next 40 years, if you were to do that investing scheme investing scheme in a basic cash investment similar to a savings account, that investment would be worth around $230,000 in 40 years. And this is even a little generous given that slightly high estimate of 3%. But if you were to follow that same investing scheme, but investing in bonds this time, that investment would be worth around $550,000 in 40 years. And finally, here on the left, you can see if you were to invest $250 per month for the next 40 years into a well-diversified stock portfolio, averaging around a 10% annual return, that same investment would be worth around $1.6 million after 40 years. So quite a discrepancy between these three types of investments, which we will cover more in depth here in a bit. And although this is a hypothetical scenario, it does effectively depict the power of compounding interest along with the various returns associated with the different types of investments. And I think the biggest takeaway from this chart is that building wealth through investing is 100% achievable. If you are careful and consistent, you can generate returns. While you might not be able to afford to invest $250 per month right away, you can start smaller with something like $50 a month or even less and work your way up from there. And so now we will go a bit more in depth into each type of investment. Although it might seem a bit overwhelming at first, I can assure you that with little time and effort, you can have a solid understanding of all of these in no time. And so here is what is called an investment spectrum. As you can see on the left, cash investments are associated with lower risks and lower returns, as well as a shorter time frame. And these would be known as the safest investments in terms of risk. While on the opposite side of the spectrum are equity investments, most commonly stocks, which are associated with higher risks, potentially higher returns, and a longer time frame. And these would be classified as riskier investments. As for bond investments, they lie in the middle of the spectrum, offering lower risks than equity investments, yet higher returns than traditional cash investments. And these are a fairly safe investment, which offer a higher return than cash investments. And now we'll touch on some examples of each type of investment. So for traditional cash investments or the safest investments, these include your standard savings account, a money market account, and a certificate of deposit or CD. So a standard savings account is the savings account that most of you are probably familiar with. To encourage individuals to keep their money with them, banks will offer very low interest rates, on average around 0.05% on the money that is kept in the saving account. A money market account is basically a hybrid of a checking and savings account that usually offers slightly higher interest rates at around 0.08% to 0.11%. And finally, a certificate of deposit or CD is essentially a savings account that holds a fixed amount of money for a fixed period of time. And in exchange, the issuing bank pays interest, usually around 0.5% to 1%. And with CDs, the longer the specified time period is, usually the interest rate goes up as well. They're directly correlated. So the longer the time period, the higher the interest rate will be. And although these investments are in fact very safe, their associated returns are on average less than the rate of inflation, which we saw a couple slides ago was around 2.2% right now. So although technically your amount of money is growing, its value in terms of buying power might not necessarily be growing given the higher inflation rate. And so now for bonds or debt investments, bonds are issued by investors from companies, governments, and other organizations to raise money. A bond is essentially an IOU in the sense that your investment is a loan of money to an entity who will repay your initial investment, or the principal it's called, at the end of the specified time period, along with the regularly occurring interest payments during the life of the bond. And so bonds can add a sense of stability to a diversified portfolio, being that they are a much safer investment than, say, stocks. And you can purchase bonds from the federal government, from corporations, or even your local city. Those are called municipal bonds. You can purchase them from foreign governments, foreign corporations as well. And on average, the cumulative bond market return is about 6.34%, according to that Barclays US Aggregate Bond Index that we saw earlier. And so now for equity investments, or most commonly known as stocks. A stock is a security that represents a share or partial ownership of a company. So the more stock you own, the greater your ownership share of that company is. And stocks go up in value as the company performs well, and they go down in value when the company performs poorly. The value of a stock investment is much more volatile than bonds or cash investments because it is completely dependent on how well the company performs, which is really hard to predict. And so different stocks result in different returns that vary based on a number of factors, including the size of the company, the industry in which they operate in, the stage of the maturity of the company. So for example, younger companies have much more room to grow. Like over the past few years, we've seen Tesla compared to an older mature company, like say Coke, for example, which experiences smaller returns, but very consistent return. And the next type of investment is called a mutual fund. A mutual fund is a type of financial vehicle that is made up of a pool of collected money from several different investors to invest in securities like stocks, bonds, and other assets. Mutual funds are managed by professional money managers who charge a fee for the services of picking which securities to invest in and allocating the funds appropriately. And these fund managers usually charge a base fee or an annual fee, which is usually a flat rate, as well as an additional fee in the form of a percentage of the gains that the fund creates. So if you invest in a mutual fund and you experience a loss, you only have to pay the base fee, which is a flat rate. But if you experience gains, then you will oftentimes have to, the money managers will collect a percentage of that gain as a fee. And so mutual funds attempt to outperform the market by conducting extensive research and handpicking which securities they think will perform. It is considered an active investment because, again, the manager is handpicking and actively picking which stocks they want to invest in or what other assets and how they should allocate the funds proportionally amongst those investments. And the individual investors' share on the gains of the mutual fund are proportional to the size of the investment they made to get into the fund. So if someone owns half the fund, they are entitled to half of the gains minus the fees, obviously. All right, and lastly, I'll touch on exchange traded funds, or ETFs. An ETF is a security that involves a collection of securities like stocks that often track an underlying index, like the S&P 500 index we had mentioned earlier. And ETFs are similar in nature to mutual funds in the sense that they are an investment in a basket full of different securities rather than just one specific security. But the biggest differences are that ETFs are listed on exchanges, a stock exchange like the New York Stock Exchange, and are traded throughout the day, just like an ordinary stock, hence the name exchange traded fund, while a mutual fund can only be bought into at its set price at the market close, or also known as the end of the trading day. And additionally, ETFs also often have lower fees associated with them than a mutual fund, making them potentially more appealing to the novice investor who's trying to avoid paying fees. And some examples of ETFs would be the S&P 500 index ETF, which tracks the S&P 500 index. And so each company's share within the ETF is, so the amount of, so like say you invest $10 into that ETF, how that $10 will be distributed amongst the 500 largest companies is proportional to how big each company is in terms of the size of its value or market capitalization, which is a fancy word for the number of shares outstanding that that company has multiplied by that stock's current price. That is called market capitalization, which basically just means how much that company is worth. So the S&P 500 proportionally allocates these investments based on the size of market cap. So the biggest companies like the Apples, the Microsofts, they will get more of the investment allocated to them than say the 500 ranked largest company, who would be very small in comparison. And so rather than hand picking which stocks you think will do well like a mutual fund manager does, Exchange traded funds allow you to easily diversify and invest in an industry or the market as a whole in the case of the S&P 500 index ETF. And the ticker for that index, in case anyone is wondering, is called SPY. It's a really awesome ETF. And some other ETFs consist of oil companies or utility companies or companies focused on sustainability. Basically, if there's a classification for a group of companies, there is a good chance that there is an ETF that tracks them. And most brokers provide a detailed listing of what ETFs are available on their services. So yeah, I would highly recommend checking out ETFs and learning more about them, as they are a great investment vehicle. And so now we'll briefly touch on the idea of diversification I've mentioned a few times. So this picture provides an example of what a diversified portfolio might look like. And notice how the different sized pieces of the pie represent different types of investment. So there's larger pieces and smaller pieces for different types of investment. And the idea behind diversification is to avoid putting all of your eggs in one basket or one type of investment. Say, for example, you put all of the money you have to invest into the stock of one single company. If that company does really well, you might experience a healthy return. But if that company does poorly, you can suffer a sizable loss. And so by diversifying, you are spreading out the risk that you're taking on. And the goal is to be diversified enough so that the losses that may result from some of your investment are largely offset by the gains that result from your other investment. And so now that you have the basics down on a few of the most common types of investments, here are a few resources that I really like that you can use going forward to expand your breadth of knowledge. So Yahoo Finance is a great sort of one-stop shop that provides up-to-date financial news, data, and commentary, including stock quotes and prices, as well as company-specific news. Investopedia is a great resource for a quick search on an investment term that you might not be super familiar with. They provide financial and investment dictionaries and detailed explanations on just about anything. I use Investopedia all the time. If I'm not super familiar with the word, I'll just give it a quick search and it'll provide me with several paragraphs giving me a very detailed explanation on what exactly it is I'm looking at. And as you move forward and become a bit more familiar with investing, you might want to use the SEC, which is the Security and Exchange Commissions. They kind of monitor, they regulate all of the public companies. And through SEC Edgar, they provide access to companies' financial reports, which include their yearly financial statements and management discussion and analysis reports, which give a lot of detail on the directions or that a company is heading in or decisions they're making, as well as the risk that they face and they expect to face in the future. But be warned, these financial reports are extremely long and very dry. Not the most exciting read, but full of great information. And so now comes picking a broker. So there are quite a few things to consider when picking a broker, including, is there a minimum deposit required? Are there annual or monthly account maintenance fees? Does the broker offer access to a trading platform as part of their as part of their free membership? If you are interested in mutual funds or exchange traded funds, are there fee-free options available? And so the point in case being here is you should do extensive research before making any decision on one particular broker. Excuse me. And so just to provide a few examples of some common brokers out there. Robinhood is very popular right now, and for a lot of good reasons. There are no fees involved, but there is not access to mutual funds as a result, because as I said earlier, mutual fund managers collect a fee. So with a no fee platform like Robinhood, you are kind of trading off that access to mutual funds. And with Robinhood, there is also little to no professional guidance that comes with using the app. So if that is something you are looking for, you might consider using one of these different brokers. So TD Ameritrade, Fidelity, and Charles Schwab are all pretty comparable in the sense that there are no fees for trading stocks or ETFs. And in addition, they do offer access to mutual funds with a management fee. I believe the base fee is, I think, $49.99 a year for these three particular brokers. And they also have much more educational offerings than Robinhood. So if that is something you're looking for, one of these three might be a good option for you. And all of these brokers listed have no minimum account fees, which is really great for someone who's just trying to get started with investing. And all but, I believe, TD Ameritrade will give you a free stock just for signing up, which is just a really cool added bonus to using one of these brokers. And so the point here is that all of these brokers are great starting spots for the novice investor, and you should do some research before deciding on one. Okay, and just to provide a simple real life scenario to make all this a bit more applicable to a soon to be or recent graduate, say for example, you're gifted $1,000 for graduation and you're not sure what to spend it on, and 1,000 is an arbitrary number, it could be any amount. But rather than making an impulsive purchase, say a PS5 or something, I don't know, you can start investing for your future instead. So you can put all or some of that money into one of the different types of investments we covered today and make your money work for you. And what I mean by that is rather than buying some material item that will depreciate in value over time, you might buy some stock in a couple different companies and watch your money grow over time instead. All right, so as we wrap things up, I want to summarize a few key takeaways that I hope you can leave with. So remember that investing is a marathon, not a sprint. Think long term and understand the returns we desire take times. There are no shortcuts. Additionally, always remember to do extensive research before making any financial decision, whether that may be deciding on a broker or deciding on an investment. Just make sure you aren't just following the trends, you are doing research and making an informed decision. Next, becoming familiar with the different types of investments and different industries within the market will be very beneficial for you as you progress and as an investor. Next, don't swing for the fences. Basically meaning don't put all of your money into one single investment, hoping that it will boom and get you rich quick. Remember to diversify. And lastly, you can start investing in your future and generating returns even if you have limited capital to invest to start off. Like I said, it is a marathon, not a sprint. And even if it's something small to start off, like 25 bucks a month, that's a great start and puts you ahead of a lot of people who are doing nothing. And you can just build it up from there. And so here I have a simple 5-step plan for you to get started investing. First would be step 1, determine why you want to start investing and do extensive research before you decide on a broker. Ask people that you know what broker they use. There's also a lot of great resources on the internet as well. Number 2, determine your risk tolerance and comfortability. If you are more of a risk averse person, consider cash investments, bonds, and exchange traded funds. If you are more comfortable taking on some additional risk, perhaps you want to do some research on a few specific companies and decide if you would like to invest in them, or you might also consider investing in a mutual fund. Third, regardless of your risk tolerance, always do your research before making an investment. And remember that an informed investment decision will always be better than an impulsive one. And fourth, diversify your knowledge and your portfolio. Learning more about the different types of investments that are out there will better your ability to diversify your portfolio and mitigate risk. And finally, be patient. Investing is not a get-rich-quick scheme, and patience is essential to see the returns that you're desiring. All right, and as we conclude, remember to visit our website at financialwellness.uoregon.edu to schedule a one-on-one appointment with a peer financial coach. We have appointments available through week 10 of this term, and then we will be starting back up again in the spring. And remember to stay connected with the Financial Wellness Center. You can find us on Instagram and Twitter at UOFinWellness, as well as YouTube and Facebook at UO Financial Wellness. All right, and with that, do we have any questions?
There was one question, Lucas. The question was, are bonds insured by the FDIC or only savings? And I provided an answer. That was the one I saw.
Yeah, so the biggest benefit is probably just the accessibility of it being an online broker. You can do it through an app on your phone rather than doing it in person. But again, that's all kind of personal preference. the general purpose is the same amongst all brokers. Is it worth it? And again, your second part of the question, is it worth paying a fee just to be able to talk to someone? That is kind of a subjective question, really up to your personal preference. There's a lot of great resources online that you can do a lot of research on that cover all the different brokers. So I hope that helps answer that question. Yeah, so that's a great question. I am not a financial advisor. I wouldn't be comfortable giving you any financial advice, but in terms of securing a retirement plan, yeah, maybe Gilbert, do you want to touch on that one maybe?
Sure. So as far as saving for retirement, the biggest thing with that is starting as soon as possible, as soon as you have income coming in. So you could set that up, through one of the brokers that Lucas mentioned, or you can set up your own little individual retirement account, either an IRA or a Roth. But if you don't have an employer, then you probably set it up on your own. But if you're employed, I'm not sure how the GE situation works, or if they allow anything through the school. But if not, you can always start on your own, which I recommend as soon as possible. And Lucas he spoke quite a bit about dollar cost averaging and just being consistent with what you're putting in. If you start now and say put in $25 a month, at least until you start making more money, that would put you so far ahead of everyone else by just getting that early start. So it's good that you're thinking about it now.
All right, so it looks like that might be it as far as questions go. So yeah, just real quick, I just want to thank you all for attending. It means a lot to me and the Financial Wellness Center. And just please stay connected and take advantage of the